So investors have their attention fixed on today's 152.2 billion naira T-bills auction. Traders at Access Bank say that the wait and see approach will keep markets quiet as investors continue cherry picking across the curve. Ladi Belo, the fixed income trader at Access Bank, joins me now for more on the markets. Thank you so much for your time today, Ladi. And let's first get a sense of how the market is positioning this week for this auction.
Hi, good afternoon. Thank you for having me. So this week, like you rightfully mentioned, we have an NTB maturity of about 152 billion, and that's exactly what we expect the DMO to offer and also to allocate at the end of this auction. From the preceding auction last week, we saw stop rates on the 364-day maturity clear at about 12.55%. But going into today, given the illiquidity in the money markets, currently we stand at about 133 billion in the red. We expect to see marginal rates on this front go up, but we don't expect to see the slip in these rates go up too much. So we expect about 45 basis points increment to close around the 13% mark. But by and large, we've seen minimal activity within the fixed income space, both bonds and treasury bills, simply because of the illiquidity that has persisted, stemming from some of the debits that were passed later last week. The LDR and some of the CRR debits. So what we've seen is banks shifting their attention towards focusing on funding for their existing obligations as when they fall due.
But how do you see the liquidity situation panning out in the next quarter?
It seems like the harshest level of liquidity will be experienced in the month of September. I think we've already been through the slimmest liquidity levels. So going into October, November, and throughout the end of the year, we expect liquidity in the system to be a little bit more robust. And as such, we expect yields across both fronts to gradually trend downwards. But obviously, the policy direction stemming from when we finally get an established CBN governor will further dictate the pace of the market.
Yeah, but Ladi, looking at that pace of the market and the developments that we're seeing play out there, what's your take on how the FTSE downgrade will impact sentiment in the market going forward?
Please repeat that.
The FTSE downgrade, FTSE, how do you think that's going to impact the market going forward?
By and large, we've seen several downgrades over the last couple of months. We've seen downgrades from the likes of Fitch and Moody's, but given the resilience of the economy and what we have in the form of receivables, we have dollar receivables as a nation. So when you compare the size and the strength of the economy in comparison to some of the comparables, you would see that we're a little bit more resilient and will continue to thrive despite the no flows received from some of our usual offshore counterparties. So we've seen minimal intervention from the CBN as well on the FX front. And as soon as we establish a more unified rate and a free flow supply on the FX side, we shall see continued activity within the fixed income space, regardless of any downgrades that we've seen in recent times.
But when you look at current interest rate levels, do you see that being sustained? And more or less, what's your take on in the medium term?
Okay, previous to now, we've seen 16% as a reference rate, as a time where the market typically turns. Right now, at the last bond auction that was conducted on Monday, we saw marginal rates on the 30-year reopening, that's the 2053 bond close at around 16.25%. This is coming from the 15.85% that we saw in the month of August. The rates that we're experiencing in the market right now typically are not sustainable. But if you look at the arbitrage or the disparity between where we have inflation as well as the interest rates in the market, you can see that the real returns are still negative. So this indicates that there's still more room for an increment in yields in the near term. But given the levels at which the pension funds and the real money buyers, such as the asset management firms, are interested in the markets, we'll still see a bit of deployment of some of their idle funds within this space. So this 16% level seems like a threshold that local players are willing to participate in. And as such, we expect rates to gradually trend downwards as the local players also become more comfortable with these levels.
But when you look at the T-bills primary market, and I'd like to know what's driving sentiments in the short end of the curve there.
Right. When there's panic in the market or when yields are unpredictable in the near term, typically what we see is the players within this space trend towards the shorter end of the curve or other money market instruments. So what we've seen in recent times, when you check out the subscription on the NTB auctions, is a lot higher than what we've seen on the bond side. We have subscriptions ranging from about 600 to 800 billion on the Treasury bill side, where we're struggling to get a subscription of 300 billion. What we saw was about 290 billion at the last auction on Monday. So we're seeing a little bit more willingness to participate on the short end of the curve, especially maturities that have especially instruments that have a tenor to maturity within this year. So the November, December 2023 bills, we're still going to see activity there, because when there's a flight to safety, typically speaking, market players trade on the shorter end of the curve.
All right, thank you so much for that. Ladi Belo, fixed income dealer at Access Bank.